Okay, let's unpack this. Have you ever looked at a company that seems to be, well, everywhere in its home market and wondered how it achieved such dominance? Especially, in rapidly evolving regions. Today, we're doing a deep dive into Mercado Libre, or MELI, as it's known on the stock market. And this isn't just an e-commerce giant, it's really a multifaceted platform that's fundamentally reshaping how people shop, pay, and even borrow money across Latin America.
It really is. And what's truly fascinating here, I think, is how Mercado Libre is making these bold strategic plays, really going after a massive, still largely untapped market. To understand this, we've pulled together quite a comprehensive stack of sources. We've got their recent Q2 2025 earnings report,
Yeah.
the detailed call transcripts, granular financial data, and various analyst perspectives. So our mission for this deep dive is basically to cut through all the noise, all the
Yeah,
numbers.
get to the core.
Exactly. Uncover the core strategic decisions and hopefully reveal the future outlook for MELI so you can walk away not just informed, but maybe with some genuinely surprising insights into this regional titan.
Absolutely. Our goal is to give you a clear, concise understanding of what makes MELI tick, connecting, the dots between their operational moves and their financial performance. So let's start with the basics, because some people might not realize just how expansive Mercado Libre truly is. It's far more than just a place to buy things online. I mean, at its foundation, sure, you have the Mercado Libre marketplace. That's the automated online commerce platform. Businesses, merchants, individuals list and sell pretty much everything imaginable. But what truly sets them apart, I think, is the ecosystem built around it.
Mhm.
There's Mercado Pago FinTech, their financial technology arm, which is just monumental.
It really is.
It enables seamless online payments, money transfers, even lets users invest funds through Mercado Fondo. Then actually getting all those products to customers, especially across Latin America's vast geography, that relies on Mercado Envios, their logistics solution, which is
A
huge.
massive undertaking, yeah.
And they don't stop there. They also offer Mercado Credito for loans, classifieds for bigger assets like cars and real estate, an incredibly fast-growing ads platform, and Mercado Shops for setting up individual digital storefronts. It's not just a company, it feels more like a self-reinforcing digital economy.
That self-reinforcing part is absolutely key. Mercado Libre was incorporated way back in 1999, headquartered in Montevideo, Uruguay. So they positioned themselves early for the region's digital transformation. And today, well, it commands a staggering market capitalization of $118.37 billion, trading around $2,353.70 USD per share. This scale isn't just a number, it's a critical component of its competitive strength. It lets them invest aggressively where maybe others can't.
Right. And to give you a sense of just how big that is in terms of market influence and operational scale, well, Mercado Libre really stands alongside global e-commerce and fintech heavyweights. You think Shopify, PDD Holdings. It's not just a Latin American player, it's definitely a global force to watch. Okay, so let's pull back the curtain on their latest performance. Mercado Libre just dropped its Q2 2025 earnings report, and it revealed kind of a fascinating paradox, didn't it?
It really did.
A significant revenue surge, yet an earnings per share miss. What did we learn from that strategic tension point?
You hit on the paradox perfectly. The headline numbers were indeed strong. Revenue surged over 30% year-on-year, hitting $6.8 billion. And they achieved a record income from operations of $825 million. Impressive stuff.
Sounds great so far.
However, and this is where it gets really interesting for investors, their earnings per share, or EPS, missed analyst estimates. But this wasn't like an accidental stumble. It seems like it was a deliberate strategic choice. The primary reason was a significant planned increase in spending on marketing and logistics, which intentionally compressed profit margins.
Right, so they chose growth over immediate profit margin.
Exactly. It signals managed willingness to sacrifice those short-term profits for aggressive market capture and, long-term dominance. It's a classic growth playbook, but executed with precision in a market that's just ripe for disruption.
So this short-term profit pressure is a deliberate strategic choice for long-term market dominance. What were the specific drivers behind that impressive top-line growth then, especially on the e-commerce side?
Well, on the e-commerce front, the momentum is pretty undeniable, especially in Brazil and Mexico. In Brazil, they strategically lowered the free shipping threshold for the third time, from BRL 79 down to a remarkable BRL 19.
19 Brazilian reais. Wow.
Yeah. It's not just a small tweak. It feels like a calculated move to attract a massive wave of new users, enhance engagement for existing ones, broaden their product assortment because more items qualify now, and really accelerate gross merchandise volume, or GMV, growth.
Makes sense.
And Mexico also saw a significant GMV acceleration. Actually, the fastest increase in items sold in nearly 2 years, fueled by strong first-party, that's sales of their own inventory, and cross-border performance, which means items sold by international sellers to local buyers. These are all about extending their reach and really deepening their market penetration.
Okay. And beyond traditional e-commerce, where is Mercado Libre truly making its boldest moves? Is it still primarily the fintech arm, Mercado Pago, driving that aggressive expansion, or are there other surprises maybe?
Oh, Mercado Pago absolutely remains a cornerstone, a major growth engine, and now boasts, get this, 68 million monthly active users.
68 million.
Yeah, and its assets under management have more than doubled year on year. This platform is also key to their rapidly expanding credit portfolio, which has surged to over $9.3 billion. That's a phenomenal 91% year-on-year growth.
91%.
And they even issued 1.5 million new credit cards in Q2 alone. The scale of this fintech operation makes it just a dominant player in its own right.
That credit portfolio growth, over $9 billion, is staggering. But in such a rapidly expanding, often volatile market, how confident are we really in the health of that portfolio, especially with NPLs showing that slight increase you mentioned?
Right.
What are the key indicators beyond just management saying, we're confident, what should we look for?
That's a crucial question, and it's definitely something analysts scrutinize closely. While 90-plus days non-performing loans, or NPLs, that's loans past due by 90 days, did see a slight sequential increase.
Okay.
Management expressed strong confidence in the portfolio's overall health. They cited robust asset quality and, importantly, stable net interest margin adjusted for losses, or NIML. Think of NIML as the true profit margin on their loans after you account for expected bad debts. Its stability suggests their risk management is pretty robust. It indicates they're not just growing the loan book wildly, but managing its health effectively, which is critical for any fintech.
Got it. So stability there is key.
Exactly. It's also worth noting their strategic shift towards increased third-party funding for credit cards, which diversifies funding sources and is expected to impact NIML, but in a managed way. They also mentioned a minor expected reduction in interest rates paid to users in Argentina from 27% down to 25% due to changes in reserve requirements. Small adjustments, but they impact the overall profitability and credit.
Indeed. It sounds like a complex but seemingly well-managed balancing act. And speaking of strategic initiatives, while e-commerce and fintech grab the headlines, I noticed another area that seems to be quietly exploding: advertising revenue. What's making that segment such a high-potential growth driver for them?
Yeah, advertising revenue is undeniably emerging as a significant and high-potential stream, often overlooked, I think, by those focusing solely on GMV. It surged by 38% year-on-year, or an even more impressive 59% on an FX-neutral basis.
59%, wow.
Right. So that means looking at the growth without the distorting effects of currency fluctuations gives us a clearer picture of the underlying business momentum. This growth has been bolstered by strategic integrations like Google Manager, positioning Mercado Ads as a key partner for brand advertisers across the region. And what's particularly fascinating here is how they're leveraging AI to optimize marketing efforts, assist sellers with everything from ad creatives to bidding strategies.
Ah, the AI angle.
Exactly. They're calling this a huge opportunity, and it's clear they're investing heavily in building out this, robust high-margin revenue stream. And if we connect this all back to the bigger picture, Mercado Libre possesses what analysts call a wide economic moat.
Right, the moat.
And this isn't just corporate jargon. It's a fundamental competitive advantage, a fortress built brick by digital brick, really. Think about it. Once you're selling on Mercado Libre, using Mercado Pago for transactions, leveraging Mercado Envios for logistics, the sheer inertia makes switching to a competitor incredibly costly and inconvenient.
The switching costs, yeah.
That integrated ecosystem locks users in, creates powerful network effects. Plus, their massive scale grants them significant cost advantages within Latin America's e-commerce and fintech markets, which are still, as we said, largely underpenetrated. These are reinforcing elements that allow Mercado Libre to defend its market share and profitability.
So, okay, if they have such a strong moat, what does this aggressive spending mean for profitability, especially that intentional increase in sales and marketing, almost 50% year on year, which, as you said, compressed margins by 1 percentage point? It's clearly a long-term play, but what's the strategic calculus?
Exactly. Management emphasizes these aren't just expenses. They view them as necessary investments to capitalize on Latin America's immense market potential. Consider this. E-commerce penetration there is still only around 15%.
Only 15%.
Compare that to mature markets like the US or China, significantly higher. That's just huge untapped potential. So the increased spending is deployed across high-profile campaigns from Mercado Pago, those large-scale commerce promotions tied to free shipping and rapidly scaling faster logistics. They expect these aggressive efforts to be net positive for the P&L in the longer term by boosting user engagement, increasing purchasing frequency, and crucially, reducing unit shipping costs through the sheer scale they gain as they become the undisputed market leader.
It's a calculated bet on future dominant profitability.
Precisely.
And looking forward, their own statements are incredibly bullish. They're very bullish on continued growth in credit issuance, advertising, aiming for the widest selection to be the destination of choice for e-commerce in Latin America. It's clear they envision this comprehensive, deeply integrated presence that becomes, well, indispensable to users across the region. So, is this strategic spending a brilliant move or maybe a risky gamble? As always, the market seems divided. Analysts are drawing lines in the sand on MELI's trajectory. What are the key bull and bear arguments we're seeing?
Well, on the bull side, analysts highlight that dominant and integrated ecosystem we talked about, e-commerce, fintech, logistics. That creates that strong competitive moat.
Right.
They point to the vast untapped market potential in Latin America and see these strategic long-term investments as key drivers for future profitability. Plus, the robust growth in fintech, the credit portfolio, along with that high-potential advertising revenue stream, these are all strong positives that could fuel, exponential growth.
Okay, that's the bull case. What about the bears?
The bear arguments focus squarely on the near-term profitability pressure due to these heavy investments. They flag potential credit portfolio risks, referencing that sequential increase in 90-plus days NPLs, and how the shift to third-party funding, while diversifying, could affect the MEL.
Okay, the NIML impact again.
Bears also worry about the intensifying competitive landscape, especially in low average selling price segments, and the exposure to macroeconomic volatility, regulatory factors, potential tariff risks in Brazil or Argentina's reserve requirements, things like that.
Micro risks, yeah.
And finally, some bears suggest the current valuation already reflects very high growth expectations, potentially limiting immediate upside, arguing that maybe the future potential is already priced in.
It's a fascinating balance, isn't it? Enormous potential versus immediate cost. To give you some context on the financial numbers, Mercado Libre's trailing 12 months revenue stands at $24.1 billion, net income of $2.05 billion, and a very healthy free cash flow of $7.21 billion. Their current PE ratio, price to earnings, on a trailing 12 months basis is 57.66.
Which sounds high.
It does sound high compared to more mature companies. But for a growth story like MELI, it really indicates the market is pricing in substantial future earnings growth. It reflects that bullish sentiment we discussed and the massive untapped market. Their current share price, around $2,353.70, is actually slightly below our fair value estimate of $2,444.19 and our price target of $2,670. It's also worth noting the analyst's average price target for the last 6 months is sitting right around $2,700.
Right. And looking ahead, analysts expect revenue to reach $27.85 billion in fiscal year 2025, and EPS to be around $47.81. So that shows continued anticipated growth despite those short-term pressures. This consistent projection really underscores the market's belief in their long-term strategy and, well, the vast opportunities still available in Latin America.
So there you have it, a pretty comprehensive look at Mercado Libre. It's clearly a company making significant short-term sacrifices for what they believe is massive long-term gain in a dynamic, rapidly evolving region. This isn't just about selling products online. It feels like it's about building an entire digital economy from the ground up.
Which raises an important question for you, the listener, I think. As Mercado Libre continues to aggressively expand into new user segments, leverages AI to optimize its operations, and aims to be that destination of choice for e-commerce and fintech, how effectively can they truly dominate? And maybe more importantly for investors, how much of that ambitious long-term potential is already factored into its current valuation? It's definitely a story of growth and calculated risk playing out in real time.
We really hope this deep dive gave you a fast track to being well-informed on Mercado Libre and its strategic maneuvers. If you found this discussion insightful, we invite you to join us for more. To support this channel and ensure you don't miss any of our future deep dives, please take just a moment to subscribe